Tuesday, September 27th, 2022, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the law of unintended consequences and also at a saying that goes like this: there's no such thing as a free lunch, or money doesn't grow on trees, or like my dad used to say, I'm not a shareholder of the light company when I was younger and left the lights on in the house. And we're going to look in particular at the UK government, the new government that came into power in the beginning of September. Before I start, though, I'd like to thank all my viewers, all my subscribers, all of you who support the channel. Yes, my channel has been growing gradually for the last 6 years. It hasn't really gone viral, but that's the way it is. And I'm not here trying to get numbers up like subscribers or anything like that. I'm just trying to provide good content. But make sure though that you subscribe to my channel, that if you like my videos, that you hit the little like button, hit the notification bell as well, as I make videos every day. So thanks again, everyone, and thanks for your interaction with the channel, with the comment section. I try to reply to as many people as possible. I also do a Sunday live stream at 9 p.m. London where I try to answer as many questions as possible for about just over an hour. So the old saying is very simple. You don't really get anything for free, and if someone gives you something for free, is that this person wants something in return, unless of course it's a friend or a family member that just wants to give you something. But I made a video back on, what was the date again? September 9th, just after the Truss and Kwarteng duo came out with the 150 billion, and of course 150 billion pound open-ended package to limit utility bills for the average customer in the UK to £2,500 a year. Yes, the energy crisis, rising gas prices, rising oil, electricity costs had driven the average price from around $1,300 a year to, and it was going to be, there's talk that it was going to be $6,000 by next spring or next year. So they capped it at $2,500. And how are they going to do that? Well, by borrowing 150 billion to do that in the market, through the gilt market, through the government. And I said at the time, I made a video saying government exposes taxpayers to massive liability. Well, what does that mean? Well, in energy markets, liability in energy markets, well, it means that if energy prices pick up again and go through the roof, the government is going to have to basically wear that. And when the government wears a huge loss, it comes to us. But actually, I didn't even think of what the other consequence, or I kind of did, but I didn't expect it to happen so quickly and so fast. Well, the investors in the financial markets, they realized that this was a huge gamble. And here we are on the, well, today's the 27th, but it's been happening since last week. People have been selling government bonds in droves. And what does that mean? Well, that means that they want more in terms of yield. They want the government to pay more in interest because they've seen what this is all about. And the other thing it's done, not that the pound hasn't been in a terminal decline since, I would say, 1914, and especially since 2008, more in modern history. 2007, we topped around 211, and prior to this autumn equinox currency crisis that we're having, yeah, the pound was holding around 120, but it's really accelerated, of course, and it culminated overnight Sunday and Monday morning when the pound traded through almost 103, while in my trading system it got down to 102.94. Why isn't there an exact number in the FX or Forex markets? Well, because the Forex market is traded interbank, it's over the counter, it's people phoning dealers, and so we will probably never know what was the exact low, but it was around 103, I guess. And that's because of this, because people are saying now the government wants people to have their cake and eat it. They think there's a free lunch. Governments, as I've said many times, they implement policies with a certain objective, and then the exact opposite happens. So what has also been a huge unintended consequence for consumers, because yes, people are going to be saving on their utility bills, but there's a whole host of people there, a huge number of millions of families that have mortgages, and they'll have to service that too. And a lot of these mortgages are coming due in terms of renewal. There's a huge amount of mortgage deals done last year, and a lot of them are 2-year deals. Rates are really low. People still had the mentality that interest rates are never gonna go up, but as we've seen, interest rates are really spiking higher, not just in the UK, but in the US, in Europe, everywhere. And I was on Twitter yesterday, and I think I tweeted something to the effect that there's an old saying about bull markets. They go up like an escalator. So think of bond prices going up like an escalator. And they have been doing so for since the early 80s, right? The bond markets. The yields, of course, are the when bond prices go up, yields and interest rates go down. But let's think about prices. So bond prices have been going gradually up and up and up for 40 years. It's provided easy credit for governments, for corporations, for individuals, for other institutions. And now I think bond markets have turned, but I didn't expect the turning to be so sharp. It's almost as if, yeah, we're going up the escalator and the bear market is going to go down the elevator shaft. And that's very serious, because our fiat currency system is a debt-based system. And if that were to happen, and I think it's happening, it's going to be catastrophic. We could be in the end game. We could be in John Exter's liquidity pyramid, of course. But back to the consequence to the UK consumers. Well, I'm getting news here from the BBC News. In this case, there's nothing wrong with it. Usually don't read BBC or watch the BBC for that matter, but I noticed this yesterday as well, this headline: mortgage lenders halt some deals after pound falls. I would say that the headline should be mortgage lenders halt some deals after gilt market meltdown, which is the interest rate market. But anyway, let's not punish the BBC too much. It says some mortgage deals have been withdrawn by banks and building societies due to volatility in the financial markets following the government's mini budget. Well, I would say that it's a consequence of also what we saw from this energy package. And now, yes, I think over the weekend as well, Kwasi Kwarteng, he said he was going to implement even more tax cuts, and the markets didn't like that. So let's continue. Virgin Money and Skipton Building Society halted mortgage offers for new customers, but said submitted applications would still be processed. Halifax said it would stop mortgages with product fees, which can result in better repayment rates. It comes as the Bank of England said it was monitoring the markets closely. So yes, yesterday the markets were expecting the Bank of England to maybe call an emergency meeting, which they haven't done in like 25 years, to raise interest rates, and they didn't. They sat on their hands. They made a statement saying that they would look at the rate in their next meeting, which is on November 3rd. It's a long time, right? Anyway, the bank said it would not hesitate to hike interest rates to curb inflation after the pound fell to a record low against the US dollar overnight. The pound appeared to settle at 107. I'm going to skip to the interesting part here that's got more to do with this no such thing as a free lunch. And in this case is, yes, we're going to save on our utility bills, but something else is going to go up. So here we go. Samuel Toombs, chief UK economist at Pantheon Macroeconomics, said if interest rates rise as predicted, the average household refinancing a 2-year fixed rate mortgage in the first half of next year would see monthly payments jump to £1,490 from £863. So that's £600 a month jump. You multiply that by 12, that's £7,200 a year. So here we are, maybe saving £4,000 with this energy cap, because it was expected to go to $6,000 a year. Now it's going to be around $2,500, but we're going to be paying the average household is going to be paying £7,200 more in mortgage payments. So, and this is if rates stay where the markets think they will. What if rates continue spiking and we see double-digit rates, which is very possible, because we saw that in the European sovereign debt crisis of 2011, 2012. Greek 10-year bond yields went to 40%. Some of the other periphery yields went to like 7 and even 10 or 11 double digits. So it is not out of the realms of possibility that this could happen. So here we are encapsulated, this law of no such thing as a free lunch. And it looks like we could be paying even more than we would have paid if the government hadn't put through this energy package. Of course, hopefully a lot of you have been paying off your debts, have been watching your budget, so you don't have to worry about it. So with that, let's look at where the markets are this morning. So it's just before 8:30 a.m. London time. Just a little bit of an update on Billy. Billy's been he's had problems with his toilet situation. He's usually really good. I take him out in the morning, in the evening, and he sleeps the whole night. Everything, never does anything in the house, but lately he's had a lot of problems. We took him to the vets yesterday, and the vet said he's fine. He's doing really well for his age. He just needed some prebiotic for his digestive system, so we're giving him that, see if he improves. And the vet said that's just a consequence of age. That's all it is. But he's doing well, Billy. And we'll probably go back before Christmas for another checkup. So right now we got spot gold at 1640. It's up just over 1% actually, right near the highs. At the highs. The low's been 1620. Silver is up 39 cents or just over 2% at 1873. Again, right near the highs. And we're seeing the stock market rebound as well. The Dow futures is up 1.2%, 370 points. The NASDAQ is up 1.6 or 180 points. and the S&P future is up 53 or 1.5%. FTSE is up just under 1% at 70.60. Eurostoxx 50 is up 1.4% at 33.90. So to the currencies, and before I go over the currencies, just wanted to talk a little bit about the dollar and the dollar index, of course, which is basically a measure of the dollar strength versus other fiat currencies. And I've always said that when this system implodes, this I owe you nothings dollar system, which is what a former New York Fed official called it in 1972, a guy by the name of John Exter. I always thought that when this system implodes, we would see the peripheral currencies go down first versus the dollar, and eventually the dollar would also weaken against them, but they can't really all weaken against each other and reset against each other. They have to reset against really the base of what the monetary system was prior to 1971 for thousands of years, and that is gold and silver. So again, that's what I expect eventually. And we could see the dollar, of course, top against the fiat currencies in the short to medium term. We could see, let's say, the euro go back to 120, the pound go back to 120 or even 130, and gold pick up. And gold would pick up even quicker than these fiat currencies. And I think that's where we're going forward. Anyway, sterling has rebounded. I guess nothing goes up or down in a straight line. And we're up 1.26%, so matching almost the move in gold. We're at 108.18. And the high's been 108.40, the low 106.46. The euro is up 0.5% at 96.60. The dollar's down. The dollar's down 0.5% versus the yen at 144.12. Dollar's down 0.2% versus the Swiss franc at 98.73, and the dollar's down 1/3 versus the yuan at 7.15. Look at the ruble. The dollar is down 0.75% at 58.12. Aussie dollar is up 0.75% at 65.02. The dollar is down 0.2% versus the Canadian dollar, 136.45. And the Kiwi dollar is up 1.4% at 57.15. To the general commodities, WTI crude is up 1.8% at 77.90. Brent crude is up 1.75% at 84.30. High grade copper is up 1.5% at 3.34. U.S. nat gas is up 2% at 7.15. And the Dutch nat gas futures, let's see where that is, the TTF. Well, that's up 2.3% at 100. And let's look at where the Dutch TTF futures is. Well, that's up 2.4% at 178. And now to the bond market. We'll start with the UK bond market, the gilts. The 2-year gilt yield is actually very volatile, the gilt market. It's down 23 basis points today. It was up about 40 yesterday. It's at 428 still. So all over the place. This is not going to help these mortgage providers. I guess the relief in the currency is helping the bond market. The 10-year gilt yield is down 16 basis points at 409. And I suspect treasury yields are coming off a little bit here. Maybe not as much because they didn't go up as much yesterday. The 10-year yield almost went up to 4% though yesterday. It was up about 13 basis points, just above 390. Right now, we're down 5 basis points at 383. And the 2-year yield is down 3.5 basis points at 427. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. And again, think about subscribing to my channel if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.